Hey everybody, good morning. Sorry, this was a little bit late notice on this live stream, but a lot of stuff happened this week. So we are going to take a quick look, and let's start off with what we have up here on the screen, the S&P 500. So it's been a pretty chaotic week. But if we zoom in, here's our whole rally from the October lows. So when we talked about this rally back in August, potentially materializing, the whole idea was it wasn't just going to be a counter trend bear market rally like this and then come down. So this is a really unusual state of affairs for like a bear market. And for a bear market, with the S&P just down, I think 15% or less than 15% from its all-time highs after the Fed's hiked 500 some odd basis points in a year, it's pretty remarkable. But in any case, we do have, this, what I'm calling a primary, or actually an intermediate lateral trend. If I zoom in a little bit closer, Monday's really dull day, of course, and we have this kind of like a shooting star, and that is right here at this February high. So it's resistance. We have the Fed on Wednesday. There's no way the market is going to break out before then, before the Fed, and then it just gets real volatile. Hey Ken, Adam, can y'all hear me okay? I hope so. In any case, it gets real volatile, and it's the banks selling off. So it's the banks giving basically the Fed like a warning shot across the bow. So Tuesday, let me just go to KRE, which is the regional bank index or ETF. And if we kind of just zoom back here, this is Tuesday morning. I mean, this is a really nasty decline. And Tuesday morning is when the Fed started their meeting. So it came off as a warning shot because there was absolutely no news catalyst to drive this. And then the rest of the day, Tuesday, it's kind of like this little bear flag. It's like the market's got its finger on the trigger. Hold on, let me see if this. Okay. It's like the market has its finger on the trigger as a warning to the Fed that if you do what the market's priced in, a 25 basis point cut, we're going to have a little bit of a freak out. So, of course, in Tuesday's daily wrap, actually, let me see if I can pull that up real quick. Yep. And let me just transition over. Tuesday's daily wrap. So this is a post from my subscribers. It's like the end of the day post. And you can see what's highlighted here. And it just says, today's trade looks a lot like a shot across the Fed's bow, and one that was well orchestrated. There was no catalyst for the sharp sell-off in regional banks other than what I said yesterday about the FDIC, Fed missing an opportunity to instill some confidence in the market rather than going with what was politically expedient. So instead of putting some kind of structure in place and saying, okay, the regional banks, we have this structure in place to kind of protect them, they just went to the private sector. So are we going to count on JPM to step in every time? They're going to step in when it's a great bargain for them. So there's no confidence in the regional banks, and the more the Fed hikes rates, the harder it makes it for the regional banks. They just cannot offer deposit rates that are anywhere near the risk that they're taking. The risk depositors are taking, obviously. So let's transition back to Wednesday. We get into the Fed rate hike. And I'm going to get off the screen here. We'll just go with TC2000. And here we go. So Wednesday, of course, the Fed hikes rates 25 basis points as expected. So this wasn't a surprise, although it was pretty much priced in for 100% probability until the sell-off. Then it went down to like 85%, but still probability. The market still expected that. Here's the trigger on the finger, and then if we just move forward through time, it's like the banks make good on that threat. Actually, right after Powell's press conference, which he said the banks are okay, the banks are fine. Right after that, the banks are selling off, at the end of Wednesday. And then here we come into Thursday, which you can see. I'm just going to move forward, and the banks just puke, And we'll get into something here, but we actually have a measured move that's kind of interesting. But you can see the bear flag right over here. And you have a first leg down, a second leg down. So if we just, actually, we'll just measure it right here because this is kind of a neat concept. I'm just taking it from basically the break of this trend line, which was kind of support. And there we go. It's about 9.25%. And then from the break over here, it's not going to be exact, but close enough, right? So over 12%. So it absolutely met the measured move. What's the most probable thing to happen after a measured move, whether it's a bull flag or a bear flag? The most probable thing is that you get some kind of consolidation or a bounce. I would call this a dead cat bounce, kind of filling that gap. But that's the most likely thing once that measured move is hit, not continued downside. So not saying that can't happen, but this is the most likely outcome. Yep, Apple did save the market, Adam. We were talking about that actually Thursday night. So KRE, the regional banks, absolute mess. Let's take a look at PACW real quick because this is, one of the usual suspects that came up. So PACW, let me kind of just zoom this out a little bit. Maybe we don't need that much, but yeah, let's go from here. So from these recent highs, down over 90%. So really ugly stuff going on in these banks, in these regional banks. And again, PACW has that same kind of dead cat bounce on Friday. Again, it's just the most likely probability when you have a measured move that's already been hit. So let's go on to the next thing. Thursday, the banks crashed. We got that. WAL, that's another one that's like high on the list of the market's concerns. There was a report in the Financial Times that they were looking to sell or raise cash or whatever. So you had this big, big drop, and this was really ugly. It was down, let's see, Thursday morning, it was down like over 60%. They denied that rumor later. They said there was absolutely no truth to the Financial Times story, and you got the price come back up a little bit, but still just really ugly stuff going on with these regional banks. So everything came down to basically Apple, Apple's earnings Thursday after the close. Because when we get a little bit further into this, I'm going to show you how all the different sectors are performing. And what you'll see is basically the market's last best hope to gain or to add to this rally that's been going on from October is the mega caps. So Apple beating across the board was big. And then Apple also came out with a new $90 billion stock buyback. And as we're getting out of earnings season, we're also getting out of that stock buyback window. So that could provide a lot of support. Microsoft too announced a buyback. That could provide a lot of support to these kinds of stocks. So I'm just flipping through my notes here. So Friday, Apple Bank, or Apple, the regional banks bounce. PACW bounces, but I just don't think there's any stability whatsoever in the banks. But I do want to show you one interesting thing that I found really curious. It was happening before we went to the Fed, and let me just set this up. So this is my most shorted index of stocks, and I'm going to transition this over so we're all looking at the same thing. Okay, so what you're looking at is the S&P 500 in these candlesticks. This is a 5-minute chart, and this white line is my own personal index of the most shorted stocks. Generally, they move a lot like small caps. So what we started seeing into the Fed was a little bit of short covering over here. Not a whole lot. Then we saw some big short covering into the end of the week. We get some really big short covering, relatively speaking. Now, if I zoom out and show you just how short this market is, let me go maybe a 60-minute chart. We'll get it. But if we go back, it's going to take just a second to populate that. Okay, so if we go back, I have to go back even further, sorry, daily. But basically, this most shorted index, which does change, is just off the lowest levels since the COVID crash over here. So there is huge potential for a short squeeze, but you have to have that catalyst. So I think the Fed made a big mistake. 25 basis points is not going to have any meaningful impact on inflation. You already have 50, maybe a 75 basis points still in the tube that are coming, that haven't hit the economy yet, because monetary policy operates with about a 6-month lag. So 25 basis points, it just came off as the Fed was tone deaf. They see these banks struggling and they hike again. And one point on that, I think that they are done. So they changed some of the language in the FOMC statement that pretty much set them up for not having to hike again. And we talked about this. This is the Fed funds rate in blue, and then we have the 2-year yield, which is already crossed below the Fed funds rate. So almost every other time in history when this has happened, at least, over the last 20 some odd years, the Fed is done. So the bond market actually should be setting rates, not the Fed. Here's an example of it right here, coming into the COVID crisis, gray recession shading here. So Fed funds rate moving up, rate hike cycle, 2-year crosses below, they pause, then they start cutting rates. So we've already had this happen. So my suspicion is that they are done, but they're not in a great place. And I'm going to talk about that a little bit more, but I want to show you that most shorted index. And that's kind of interesting because there is some chance for a short squeeze, but what happens is there really needs to be some confidence in these small regional banks. And let's take a look at just the price charts again. And I'm going to transition you over to TC 2000 in just a second. Okay, here we go. So last week's video was talking about changes in character that I'm seeing. I'm going to point out some, but we've been in this kind of rectangle consolidation since the start of April. Now, granted, earnings season is going to do that to some degree. Wait until you get into Q2 earnings season. In the summer doldrums, it's going to be the dullest thing you've ever seen, generally speaking. But a little bit more volatility, but this is basically a rectangle, and it's 1, 2, 3, 4, 5 weeks of this. And what we did see was the S&P, and this is what I thought was crucial, was coming down to this last Wednesday from the prior week, the low around 40.50, and hold it. So it did hold it right here, but it did not want to move back above this line before the Fed. Or actually before Apple's earnings, I'm sorry. Apple's earnings and the banks rallied Friday, so we got back up in here. But I'm going to show you just like a little closer look at this. And when I talk about changes in character, you see this? This is like a small little bear flag. And when I was writing about this on Wednesday night, I said, if we get the measured move, which comes from here, it is going to test that last Wednesday low at 40.50. And there it is right there. So we did get the measured move. But the point I'm making is, if you've watched my videos, if you're a subscriber, certainly you haven't heard me talk about bear flags very much until the last maybe 2 weeks or so. They're starting to pop up. So it's a change in character. And what I've always noticed is these small little changes in character that a lot of people miss because they don't have the time to watch the market all day like I do. Changes in character precede changes in trends. So this is what I'm talking about with last weekend's video. Another change in character. We're starting to see a lot more of these kind of bearish little price action. Even though it wasn't anything really meaningful like KRE, that bear flag was disgusting. But we're seeing them. So let's go to the next one, the Dow. It did hold up a little bit better. So broke below this and then bounced back up. This is the regional banks and Apple. So Apple saved the day. Now look where this is happening for the Dow. Remember, it did lead. Let me go to a 2-hour chart. It did lead the rally off the October lows. I have to go to a 4-hour chart. And I thought it would back then because it had the best base. It had this double bottom base over here. But you see this big triangle. So when we get these big triangles, typically a symmetrical triangle like this is a continuation pattern, consolidation continuation. But it shouldn't be over 3 weeks. So when you get into a couple months like this, they often act as tops. So look at where the Dow has been coming up to. Resistance right at the apex of that triangle. It doesn't want to go above it. So the Dow's basically done nothing since leading this rally, gained 20%. The whole call was that the mega caps and NASDAQ would rotate in January. So we're going to take a look at those. Same chart, 30-minute, and we have basically the same rectangle. But this is a really good demonstration of the change in tone or the change in character. So if we look at NASDAQ from when it rotated in, that is the first of the year, or the first trading day, January 3rd. That's when everything changed. The mega caps were just horrible last year, and then they really got beat down in December, tax law selling, and funds didn't want to have mega caps on their prospectus going into the new year because they were the worst performing of 2022. But my point is, big bull flag, you can see a smaller bull flag over here. And if I zoom in a little bit more, coming out of that big bull flag, small bull flag, small bull flag, small bull flag. Then we get a rectangle. This is a change in tone, a change in character. So a rectangle is like a symmetrical triangle. It has no inherent bullish or bearish bias of its own. It depends on the preceding trend, which is up. Now, a bull flag has a bias already. It's bullish. It does have to come after a preceding trend that's moving up, but it's a much more bullish price consolidation than a rectangle or a symmetrical triangle. So you can look at this as basically kind of some balance between the bears and the bulls. So the bulls are buying here, the bears are selling there, but there's not a lot of conviction in it. But if you look at NASDAQ, it looks much better than the other. So S&P 500 again, kind of low in this range. You know, it's just getting a little bit volatile. The Dow broke down below this range, it's coming up. But you look at the NASDAQ, and it stayed pretty much high. And this might even be like a small bull flag, but it's got much better price action, which is another reason why I think if the market's going to go any further from here, it's almost certainly going to be the mega caps that are going to carry it. Let's take a look at IWM. Absolute mess. I don't know if Brent's with us today. Brent. So we talked about Brent last week. He had excellent risk management. I was so excited about it. Had a long position in IWM, I believe, and basically he used excellent risk management, used 2% rule, took a really small loss, got out of it before it got a lot uglier in IWM. So we had this potential inverse head and shoulders. And what I was saying the whole time about this is the potential depends on the FDIC, the Fed, somebody doing something to instill some confidence in investors with those regional banks. But a couple of weeks ago, we looked at the volume pattern here, and the volume pattern is exceptionally important for a head and shoulders top, but more important for a inverse head and shoulders. So what you want to see basically is big volume over here, sellers, and then big volume over here, capitulation event on that head. So left shoulder, head, and then what you want to see is at least a little increase in volume on this rally, which you can see right over here. But then this right shoulder over here, you want to see a big increase in volume, and we didn't get that at all. So this was a really, it was just a really suspicious part of this pattern at that point, where it should look the best on volume, where it was the most important, it didn't do it. And then
you see we're kind of breaking down below this right shoulder. That invalidates the pattern. Is there a chance that this is a bigger head and shoulders, like left shoulder, head, right shoulder? There's a chance. There's also a chance that it comes down here and forms some kind of double bottom. But I can't really get excited about small caps just because there's just no confidence in the regional banks. And small caps has the most exposure to those regional banks. So real quick, I want to show you some 3C charts and what's going on there. I'm just going to set those up. Let me take a look at the comments. Any questions there? Yeah. Can you talk a bit more about how you use the most shorted index on your analysis and how you use it to gauge the market? Thanks. Okay, Ken, real simple. I think I still have it up. Yeah, let me just transition the chart back for you guys. This is the part where it's like running a studio over here. Okay, so it should be coming up. So the most shorted index is in white. I always use the S&P 500 just to be consistent. It's the benchmark index. You know, one of the things in trading or in investing is being consistent, watching your bias. It's really easy to shift the trend line a little bit. That, you know, if you're long something, you shift the trend line a little bit. It makes you feel better about your position. But it doesn't help you in the long run. So you really have to be consistent about it. That's why I use the S&P 500 to compare everything. It's a benchmark. I'm not saying, oh, let's go to the NASDAQ because it's a better comparison, or let's go to IWM. But the fact of the matter is this most shorted index moves a lot like small caps. But what I look for is, one, we have huge short exposure going on. You saw that this is basically at the lowest level since the COVID crash, you know, when everybody was short. So there's a huge potential for a short squeeze. Again, the banks have to have some confidence for that to happen because, quite frankly, that's where a lot of it is. It is really interesting to me that we did get this short squeeze, you know, a little short covering into the Fed, but a short squeeze into the end of the week. So that's interesting. If I see a really strong short squeeze, a couple things. One, I know it has the potential to create kind of like a self-fulfilling prophecy. And the more shorts are getting squeezed, the higher price is going because they have to buy to cover. So they're buying stock, they're sending the stock price higher. Any remaining shorts are at a deeper loss. They have to cover, they buy. So whatever the asset is goes higher and higher and higher. And that's the whole point of a short squeeze. That's how most bear market rallies are kind of ignited. I'm just getting a sip of water here. Actually, I'm drinking rum and coke. No, I'm kidding. Water. That's how most bear market rallies are ignited. And if you go back through history, also, the catalyst for most bear market rallies is something the Fed did or said. So if the Fed got a little less hawkish, or if they came in with a surprise rate cut, you'll see, maybe I'll put that up on the website for subscribers this week. I have a chart somewhere with all the Fed rate cuts notated, and you can see in a bear market rally, even back to the 1929 crash, the first bear market rally in that was due to the Fed. But I hope I answered your question. It's basically, it gives you kind of a heads up whether or not we're going to see a move that can really break out. Like S&P 4200 is like a really important level. It's going to need short covering to get there. Well, actually, probably the mega caps can do it on their own because of the weight. But if the mega caps rally, it's going to change the whole risk sentiment, and then you'll see everything else rally too. And when I get into some other charts, I'll show you that. But let's take a look at the SPY, and I want to go to a 5-minute chart. Tony, if you could please explain where you think we are in your part 3. Yeah, I'm going to do that. Yeah, I think we are like 7th, 8th inning, Tony. And I think I said that last week too. So basically with the SPY, we're going to look at 3C here. This isn't looking great. So this is the time frame that I've been using to track, this entire rally from the October low. So it's basically an intermediate trend. It's not a bull market or a bear market rally. It's not a new bull market. It's an intermediate lateral trend. You can really see that in small caps. And we've had just about every average rally at least 20% off the lows. But over here in March, you can see like a nice positive divergence here, and we get this rally, and we come into this April range. Now, this part is fine. This is what I would expect to see as we're going into like a month-long, 5-week consolidation. That's fine. But you can see over here, as prices just went a little bit above the top of that rectangle, we see selling into it right here. And then it's getting really ugly over here because this is the warning shot on Tuesday to the Fed, that bank sell-off. So the point being is there's a change in character here too. It's not at the level where I'd say, hey, it's time to get short everything, but as Tony just asked, it's one of those things that it makes me say, yeah, we're in like the 8th or 9th inning of that whole phase one, which I'll explain a little bit later. But what's still looking good, and we just saw it from the price charts, right? And we can see it on 3C too, is QQQ, NASDAQ 100. Over here, positive divergence. We've got good confirmation even through this kind of lateral range that we've seen. We have 3C moving up, making higher lows. And over here, it's almost starting to lead. So we've had all the mega caps, or basically most of the mega caps, report. I think the market feels pretty good about them. They tend to do better. Now this is like, okay, let me qualify this. Most of the mega caps are secular growth stocks as opposed to cyclical. So cyclicals are stocks that are going to benefit when the economy's doing better. So like materials, the materials sector, the financials, the industrials, consumer discretionary, which is a cyclical, but because of Amazon's weight and because of Tesla's weight, it trades a lot more like the mega cap heavy sectors, which are communications and tech. But their secular growth, the reason they didn't do well last year, the reason they were so ugly last year is because they have such high valuations and they're very forward looking. So basically when everybody had a chance to buy Amazon back in 2000, when the argument was still, hey, can Amazon really compete with Barnes and Noble? That was literally the argument. I read an article on, was it Bloomberg or Alpha? I can't remember. But anyway, the article was like, the guy was saying, I don't think Amazon can compete with Barnes and Noble. And Amazon is just taking everything over. So a lot of investors don't want that to happen again. So they're happy to give these forward-looking valuations that are very high on these kinds of stocks, these secular growth tech stocks. And what happens is when interest rates and inflation started to surge, all that had to be marked down really quick because of that 5-year kind of forward-looking valuation. And they did horrible. But generally speaking, if we weren't in an inflationary environment, and I think inflation's already peaked, it's still too high, but it's peaked. Generally speaking, these stocks do better than just about anything else because of their secular growth nature. So you may not go out and buy a new Tesla in the middle of a recession, right? You may not go out and buy a whole bunch of new furniture, but you're still going to use Google every day. You're still going to use Apple. You're still going to be on Facebook. So that's why they're considered more secular growth rather than cyclical. And then we have the defensive sectors, which are like counter-cyclicals, and we'll get to those. But the point I'm just trying to make is QQQ, to me, looks just far better than anything else out there. So I think if the market does have a chance to go further, it's here. On the really short-term charts, I'll show you real quick, a little bit of improvement. So let me go to SPY, which is for the S&P 500. These are the short-term charts. And the reason I say that a little bit of improvement, this is the area we saw selling right above that rectangle range, right? Remember, bulls buying down here, bears are selling up here. You can see the divergence over here. So there is the test for S&P 500 of 40.50. Last Wednesday, the 26th low, right? course, we're looking at SPY and not the S&P, but that is the 40-50 level. You can see a positive divergence there. Now 3C right here, this is a relative divergence. So we're looking at price at this point where it was a little bit above the rectangle, and price here where it's below. And look at 3C, it's higher here than it was here. So we do have a little bit more money flowing into the market right now, probably because, this is my guess, the mega caps are looking better after they've reported earnings and there was nothing horrible. They've got fortress balance sheets. They're not going to be in the news one day like Pacific West or Silicon Valley Bank. They're not going to be in the news like that. Like, yeah, the whole company fell apart. So they've got the fortress balance sheets. People feel a lot safer with them over the last 15 years. I mean, that's been the trade. So in any case, SPY looking a little bit better. And then let's look at QQQ. QQQ just looks better altogether. We had a positive divergence over here. That's that Wednesday when the S&P tested 40-50. Is that right? 40-50? And we have confirmation of this whole thing. A little bit of a negative divergence here, but this is that whole risk-off rally, that whole warning shot to the Fed. So I'm not worried about that. And a positive divergence here. So again, I think QQQ looks the best. I also like to watch high yield credit a lot. HYG, it's a very, very liquid product, and institutional money will often use it as a proxy for S&P futures. So HYG's price performance versus the S&P right now is not where I'd like it to be for a leading signal, but its 3C chart still looks pretty decent. Let me go to 5. It still looks pretty decent over here. It's got that similar consolidation as the broad market. And if we go to 3, we have that kind of funky divergence. Somebody suggested we call it a banana divergence. Yeah, how it kind of rolls up here. This one's not quite as strong, but kind of rolls up here, and then it kind of starts to go parabolic up here. So from the 3C chart, I think it looks okay. I would like to see HYG leading a breakout. But Friday with yields just spiking. And why did yields spike? Because, first of all, payrolls beat across the board, right? We had some wage inflation. Even though this payrolls report is completely just, it's garbage, it's useless. The ADP report, which used to be the worst report ever for employment, to the point where a couple months ago, after a decade, they had to reconfigure the whole thing and start from scratch. Now the ADP report is more consistent than the payrolls from the BLS. But in any case, yields spiked on Friday. So part of that was the strong payrolls. The other part of that was you had the regional banks getting that dead cat bounce, and you had all those flight to safety trades into treasuries that were being unwound. So when treasuries are bought, price goes up and the yield goes down. And conversely, when treasuries are sold, they're getting out of the safe haven, yields spike. So that's what happened Friday. That weighs on high yield credit because it's junk credit. It's high yield credit. It's corporate debt. What else we got here for you? VIX. I'm going to pull this up. I am so proud of myself that I'm actually getting the right charts up on the screen for you guys and not talking for 15 minutes, looking at the wrong chart and not noticing all the comments going, hey, we can't see what you're looking at. Okay, so I'm going to pull up VIX. Give me just a second. But I will say this, volatility is ridiculously low, extremely low, like complacent low. And let me just transition over to TC2000. So we're looking at VIX, volatility index. I'm not going to get into this right now, but for members in the daily wraps this week, I explained a lot how VVIX, the volatility of VIX, its relative performance versus the S&P. And an easy way to do that is to put the S&P and VVIX on a chart together and then invert the S&P's price. So on Thinkorswim, you would just put a minus sign in front of the S&P or the SPY or whatever you want to use. But then you can see basically the relative performance, because VIX basically tracks, at least on the short term, it tracks opposite or inversely to the S&P 500. But what we've seen really is this resistance level here at 20. And even, as we're having the banks crash on Tuesday over here and on Thursday over here, I mean, like risking financial crisis, VIX can't get above 20. When I first got into like trading in the late 90s, VIX below 20 was like, I mean, they've reworked VIX since then, because it used to be just the S&P 100. Now it's the S&P 500. But back then, it was almost like an oscillator. So if VIX was below 20, you were shorting the market. If VIX was above like 30, 35, you were buying the market. This is just ridiculously low for a market that's just gone through 500 basis points of rate hikes in a year. And, basically what has been a bear market. So I think there's a lot of complacency. Ooh, hear that? Complacency. Pretty good, right? I was a musician, so when we made a mistake, they said, just repeat the mistake and call it jazz. So we're watching this absolute breadth index. I'm not going to get into that now, but for members, you know what that is. And when that thing gives a signal, it is really high probability. We had a signal is below 14. We had it drop to 16 last week, 16 this week, did not get down to 14. Anything below 14, the lower it goes, the higher probability it is. And generally speaking, because I back tested this over years, trying to find the right level to call it a signal, generally speaking, you'll get at least a 50% move in VIX over, it could be as soon as the next day, but over the next month, up to the next month. We've had moves that were over 450% coming off of one of those signals. So it's a really high probability signal. If we see that, then I think we're even closer to moving into phase 2. And also volatility's term structure is like, it's in backwardation, as it should be, but it's really, really in backwardation. I would think it would be a lot steeper than it is right now. I just think there's a lot of complacency out there. So that is always a risk when the market gets complacent. So we looked at VIX. I do want to run through those mega cap sectors, because I do think they are kind of the market's last best hope here. And we'll start with, well, let's go in reverse order. We'll go with the one I think doesn't look as great as the others, but still looks better than most. And I'll tell you why. So this is consumer discretionary. It is a cyclical sector, but when I talk about sectors and sector performance, like in the early update, I'm talking about, what the market bias is for the day. I usually, when I say the mega cap heavy sectors, I include consumer discretionary, although it's just a major cyclical. And the reason is, again, Amazon, Tesla, they have so much weight that they move the entire sector, So if we look at it, we had something of a bull flag over here, kind of a breakout. See, the bull flag is fine. It's a little too deep for my liking, but still bull flag. And then over here, we're in this kind of triangle, right? Waiting for something to happen. Now, if we go to communications, which is another mega cap heavy sector. Why? Because you've got Facebook, Google. It looks better. You have that same bull flag. This is January 3rd, by the way, that rotation into mega caps that we were looking for. There's the bull flag. I would prefer it was smaller, but we had a lot of hot data coming in February, and yields were moving sharply higher, and these stocks don't like that. But this looks better. So we have another kind of messy little bull flag here, and it breaks out. Now let's look at the tech sector. Now this is the most heavily weighted sector. It has the most potential to move the cap weighted indices like the S&P 500. So again, here's January 3rd, the first trading day of 2023. big bull flag. It looks the best because it's not in a rectangle. It's got this bull flag here. And if we kind of take a little bit closer look, I don't know if I noted all the little bull flags, but yeah. So in my view, this is kind of what's left of this rally, kind of pinning our hopes, if you're a bull at this point, on these mega cap stocks in the tech sector. But we got into all of this last weekend with the changes in character where semiconductors aren't performing as well. Semiconductors tend to lead the tech sector. Why? Because they're more economically sensitive. Transports tend to lead the Dow Industrials. IWM or small caps tend to lead the broader market and risk sentiment. So it's just stuff like that. Or regional banks tend to lead financials. So I think they look good. And then the mega cap index, which I use, again, you can use something different if you like. I just use it for consistency because cherry picking stuff is not consistency. Again, mega cap heavy index here, the Vanguard Mega Cap 300 Growth Index. There's the start of the new year, bull flag, little wedgie pennant, and we kind of have something similar to the wedges here. But again, it looks like maybe a small bull flag. Point is, they look better than everything else. If we look at the S&P 500 again, let me go to a 30-minute chart first. And then you look at the mega caps, they just look better all over. They look better all over. So in my opinion, that's probably the way to go. And we can take a look at the, let me just show you one other thing real quick on 3C charts for a couple of these. And remember the 5-minute chart, that 5-minute trend is really the one that kind of tracks this whole rally. So I am going to transition you over to that at my little studio here. There we go. Okay, so what you're looking at is the tech sector, right? And this is a good example of a relative positive divergence. You see price is basically the same right here as it is right over here. And you can see accumulation at this first low, 3C jumping, right? At the second low, 3C's got a higher low. That is a relative positive divergence. You could almost call this like a little W base, a little W bottom. And here we have kind of a relative negative divergence because price is making higher highs, 3C isn't. This is not a huge deal because you see this a lot of times going into a consolidation. And then we have that, for lack of better term, banana divergence where it's kind of accelerating up over here. So that's the tech sector. It looks pretty strong to me. It's like one of the few sectors on this long time frame chart that still looks pretty strong. Let's take a look at MGK, that mega cap index. And although 3C is not scaled great here, it's making higher highs, higher lows, so it's confirming this trend. If I scaled it correctly, I think 3C would probably be leading price a little bit. So I think the market or the smart money is going to, if they're going to stay long, and a lot of funds, they have to be fully invested. So they have to choose something, whether it's a counter-cyclical or whatever your best option is at the time. And I think right now, the mega caps, especially after getting through earnings, probably look like the best option at the time. But keep in mind, as the mega caps rally, and we saw this in 2021, when the market was making all-time new record highs because the Fed was dumping $120 billion a month into the market, pretty much. What we saw was the mega caps carry the entire market, and we saw some of the worst market breadth, which is participation. How many stocks are participating? Some of the worst market breadth I have seen in my life of doing this. Worse than the financial crisis, worse than the dot-com bubble. And then as soon as we get into, the end of December and into January, what happens? We enter a bear market. So what happens is when you have really weak breadth and you're kind of depending on 6 to 12 mega caps to carry the whole market, and anything happens with those 6 to 12 stocks, there's no floor of support below. So when you don't have like good breadth, and that was what why I've been bullish on this rally from October. I've been bullish on it the whole time, pretty much until, I mean, there's a couple areas where I've been like, we have to watch for this, we have to watch for that. But as far as saying, hey, I think we're late in the ninth inning of this, I didn't start saying that until last week. In any case, so there we are. And one other thing I want to show you real quick is just how these groups are acting. Let me put up the S&P 500. Why? Because we want to be consistent and use the benchmark index. Now I'm going to change this. Now these are my own just equal weight watch lists. So they're not weighted like cap weighted. So the mega caps, everything is equally weighted. So what I'm going to show you first is the cyclicals. Now the cyclicals really kind of started the rally back in October. They kind of led it. So this is just an equal weight index. It's going to change in a minute here of the cyclical sectors. So you got S&P in the candlesticks, red and green, and you have the equal weight index of these cyclical sectors in white. You see what's happening here, especially since like March. They just are not looking good. So you could see, I'm going to go to a 30-minute chart. I mean, look here. This is the February high, right? This is the resistance the S&P has to get through to get to 4,200. These stocks were participating over here, the sectors. Now look what they're doing. They're not participating. So that is why we're seeing weaker breadth. You can see the participation right here. Here's the entire rally. You can see at the October low, they led. You see the higher low right over here? They led the rally. They participated here. They participated here, making a higher high. Over here? No. So this is one of the reasons I'm saying I think we're kind of late ninth inning. And let me show you the defensive sectors. These are the counter cyclicals, you know, your consumer staples, utilities, healthcare, and pull these up. Defensive. Again, it's just a equal weight index of those sectors. They've been kind of performing in line, right? But they're not performing so great here. But beyond that, I've never seen a rally really led by defensive sectors. So they're not the stocks that are going to do that. Now let's just take a look at my own little equal weight index of mega cap stocks. Now this may look like out of scale to you, it may look a little funky, but remember that last year, these were the worst performing. They were getting sold hard into December. Here's that little December consolidation where we actually first started seeing signs of accumulation in the mega caps, which is the call that mega caps were going to rotate into leadership Q1 of 2023, which they did. NASDAQ made a 20% rally since then. But you can see what happens here. They are leading the rally. So if we zoom in a little bit closer, they are, in my opinion, the market's last best hope to gain anything beyond this. And I do think that they do. So what I'm leaning toward is that we see the market led by the mega caps, and then other stuff is going to participate. But, you know, if we get another bank meltdown, you know, this is all hypothetical. So if we get another bank meltdown, that's going to be really tough. But what I'm looking for is those stocks to lead the market, the S&P to trade above 4,200. Let me pull that up for you real quick. Well, everybody knows what S&P 4,200 looks like, but so the S&P to trade above 4,200. What will happen above 4,200? Well, first of all, we'll make a higher high above this February high, so it will keep the rally intact off the October lows, because what do you need for a rally? You need higher lows and higher highs. We don't have that higher high yet because we're getting resistance right here at February's high. So if those mega caps, heavily weighted stocks, lead this rally, S&P breaks out above 4,200, you're going to have a lot of investors that have missed this rally because they've been bearish on the market. They're going to start chasing stuff. You're going to see hedge funds that have underperformed the benchmark index on the year start chasing. They're going to be closing their shorts, and you'll see a rally above 4,200. But what I think will happen and this is speculative because we don't know until we see, and this is why we watch stuff like 3C as the market develops. What I think will happen is you will see smart money, institutional money sell into price strength. So price will move higher, people will be bullish, they'll be giddy, but under the surface you'll see 3C showing distribution, and that's what I think we're headed for. So or if we don't make a higher high here, then this kind of rally's done. And we have basically two scenarios. One is that we stay in this kind of, let me take these trend lines off. We stay in this kind of lateral choppy range. It's probably easier to see with IWM. So we stay in this kind of lateral choppy range, or phase two in my outlook. And this is why I say lateral choppy range, because if you look at this, that's full-fledged bear market primary downtrend. This is an intermediate lateral trend. This is what I was calling in August, back over here, which it was the first change in character that we were seeing in the market. And then we got these bases in October. And my call was not just for a bear market rally, but a intermediate lateral trend. This is the primary trend. So we got two things that could come up. We could stay in this lateral trend, chop forward, and come down to the bottom of it, or, and this is my phase two idea, is that this primary bear trend reasserts itself. We make lower lows. At that point, you know, selling into S&P above 4,200 and getting short is going to be a very attractive proposition, I think. Let me just look at the comments here real quick. Go back to IWM so you can see those trends. Let's see. Okay, Dennis, could you explain more about VIX term structure? Yeah, so if it's just like insurance. So the more you go out, you know, like your 3-month VIX, the further you go out, it's a little bit more expensive than your 30-day VIX. So VIX itself is 30 days. And what happens when term structure goes into backwardation. Oh, I just lost my comments. Oh, there. Okay, so when term structure goes into backwardation, the 30-day VIX price goes above the 90-day or the 60-day. And what that's showing is basically panic, right? So everybody's trying to get protection here right now. But also when that happens, it tends to be a contrarian signal. So when everybody's panicking, it's kind of like everybody's on one side of the boat and the boat flips. That's what I mean by contrarian signal. So a lot of times when my VIX backwardation or my VIX term structure indicator goes into backwardation, typically we're close to a low, even though what we're seeing is a market panic, right? So what I'm saying in terms of VIX now is I'm not seeing any of that with, you know, banks crashing left and right. It just seems like we're very, very complacent. And if you look at the skew index, this is basically hedging black swan risk. Okay, so it's basically bidding up the price of deep out of the money puts. Let me change this to a line. So this is another product from CBOE, the skew index. I hope you can see it okay. But in any case, if you read the term paper on it, the white sheet, historically they say, you know, 100 to 110 is kind of the normal level. Above like 130 is elevated. But what I found in recent years is really above 150. So we're seeing a little bit of that kind of black swan hedging, you know. So people buying deep out of the money puts. So if the market crashes, they can hedge their long positions, you know, because the deep out of the money puts are going to make money, right? But if you look back here in 2021, the end of 2021, and this was another one of the big major warning signs. I'm going to zoom in a little bit. S&P makes all-time record high. Skew really, like I said in the term paper, I don't even think they had seen it above 150. So it started doing that in recent years. But this is like red flag, red alert level. That is December of 2021 when the S&P made its final bull market high, final record high, and then we go into a bear market. So there is a lot of utility in this because the average investor isn't using this, or the average trader, the kind of a mom and pop retail, isn't using this kind of option strategy to hedge their portfolios like smart money, hedge funds, institutional money are doing. So we see a little bit, moving into the 134, up here 138. So we're seeing a little bit, but there's still a lot of complacency, I think. And hopefully that kind of answers your question, or over answers it in that instance. Ken, what are your thoughts about oil OPEC production cut? And oil seems to be predicting us. Okay, yeah. So last weekend, this is something I actually wanted to cover. Last weekend, if you joined the live stream, I was asked, I think by Rounder, right, about USO. Let me see. I think I'll pull up just USO. Let's do that. And what the question was whether or not it was still kind of in a bear flag. So let me zoom out just a little bit so you can see better. And you're right about what you said about oil crashing, or kind of really taking a beating. So when I have made major bear market calls when the stock market was still trading at all-time record highs, like 5 weeks before COVID, before the 2018 20% crash, when I make those calls, generally what I'm seeing are big moves down in commodities like oil, like copper. We're in a different environment now because of inflation. So I'm not sure how that's all going to pan out. But when you see, a big 20% drop in oil over a very short period of time, you see kind of commodity currencies like the Australian dollar doing the same thing. And typically, I would say yields too, but because the Fed is kind of controlling the short end, I'm not sure how much yields will play into that. I think they probably will, because the market's a little bit smarter than the Fed. And you can see the market's been diverging with the Fed. And we'll talk about that a little bit more. But the question I was asked last week was, at that point, let's just kind of roll back. But you can see bear flags here, right? So this is just not very nice price action. And if we come to this 15-minute chart, here's a bear flag. So what he was seeing, and what he was, I think, getting involved in, was a start of a small bear flag, and was asking after this kind of big move, probably, I don't know if it ran your stops or not, Dennis. I think we talked a little bit about it, but it doesn't matter. What I was saying last weekend was, I think there's a good chance that this bear flag is turning into a larger bear flag. So what will happen, I'll have to go back to like a 60-minute chart. What will tend to happen is you'll get a couple small bear flags, and as this asset's going down, you'll get a bigger one. And what I said was you'll get a bigger measured move. So if this had stuck as just a small bear flag right here, kind of maybe was the size of this would be your measured move. You'd take it from right here, the break, to, wow, phooey. Hang on one sec, guys. Sorry. So sorry. Breaking glass. Okay, so your measured move would be this, right? About 5%. What I was saying is, if you get this bigger bear flag, you're going to get a bigger measured move. So basically, you're going to take this up here, because price is almost always, it's just so weird how it's fractal, and just, I don't have the right word. Jen, do you have the right word? Jen doesn't even know what I'm talking about, but she's here helping. So here's our measured move, 9.5%, right? And let's take the breakdown from the bear flag, and that's where you want to measure from. I'm trying to get the little pointer there without moving. Let's just call it that, okay? Let's just call it that. And what is our measured move here? 9.8%. I mean, this is the most spectacular thing. I've known this forever. I've been giving you guys measured moves on the subscriber website forever, but every time I see it, I'm still blown away by how accurate they are. 9.5% measured move. You get the 9.8% drop in crude over there. I will show you one thing. What I said to subscribers earlier this week is, again, once a measured move is hit, the most probable outcome is either you go into another consolidation, and if that were the case in this particular price trend, I would assume that it would probably be a bearish one, or you get into a bottoming process or just kind of a dead cat bounce. But generally, you don't go lower. You hang around this measured move area, and price does something. So what I'm going to show you is, I have a slide of it here, is what crude oil futures looked like as we hit that measured move. And I'm going to have to go to this. All right, and there we're looking at crude oil futures and 3C in blue. So this is crude hitting that measured move, that downside target, same as USO, basically oil ETF. And look at 3C, like just screaming. And then we get the big jump in crude that you saw in USO's chart on Friday. But again, that's just the point. So you hit a measured move. They're incredibly accurate. And it stuns me every time I see it. I'm just, even now I've known it for years. I love it because price tells you where it's going if you're paying attention. But what we see here is, accumulation. We see people buying this kind of low. So, and we go back to USO real quick because I don't have, that was a PowerPoint slide. But if we go back to USO real quick, what you see is that divergence that I just showed you was right down here. And then we get this kind of jump on Friday. What was that? About 4%, almost 4%. So that doesn't mean, oil's going to rally big from here. It may come down. It may do like some kind of basing pattern. It may turn into a larger consolidation. But generally speaking, so if you're short something and you're short on a measured move, that's where I'd take my profits. Sometimes price will run a little past them, but then it almost always comes right back and consolidates right at the measured move area. So you could take, partial profits, and if price is still going down, take a little bit more. But generally speaking, I try to get out of the trade at that point once a measured move is hit. And that goes for bullish or bearish measured moves. So I hope I answered your question, Ken. Mario. Hey, Mario. Can you discuss a look at volume this week, in particular Friday? Volume heavier this week because basically, you're seeing people freaking out with the bank selling off. Let's see. Let me try to pull up. Yeah, you're seeing heavier volume. If you look at those 30-minute charts that we went through with all those rectangles and stuff, those consolidation patterns, whether they're bullish or bearish, you want to see volume taper off. So the fact that we're seeing some heavier volume, and it's not month end, it's not, well, there's a little bit of OPEX in Fridays and stuff like that. But the fact that you're seeing that in these consolidations over the last 5 weeks is also not a great sign. Volume should be coming down. So that's what I'll say about that for now. And Ken, I made some good money yesterday. I bet you did. But it would have been a lot more and much easier if the Fed wouldn't have done that little hike. That's what I said. It was, to me, it was just tone deaf. It was almost, yeah, every Fed chair has one of their stupid comments that they can never live down. Yellen's was, "We'll never see a financial crisis again in my lifetime," which we did. Bernanke, I think, said something about the housing sector is fine before the financial crisis in 2008. Anyway, yeah, I think, for a 25 basis point hike, that's going to do really nothing to the trajectory of inflation. But the message that the bond market was already sending, with the 2-year yield crossing below the Fed funds rate, and the message that the banks were sending on Tuesday, no news for that sell-off. There's no catalyst. That was a message to the Fed, because the Fed, that's a 2-day meeting. It starts Tuesday. That was a message to them, right? So to me, it was just a very stupid move. It was tone deaf, like we live in ivory tower. It just wasn't worth risking a financial crisis. And the banks selling off again, like 45 minutes after Powell stopped speaking, and then the next day. I mean, the market is telling you something. And, there's this kind of narrative in mainstream media that, let's go back to KRE real quick. There's this kind of narrative in mainstream media that, oh, it's all the shorts, that are doing this, and that's why it's falling. No, there's some really serious considerations here. There's some really serious things going on. And the higher the Fed hikes rates, the worse it is for these banks. So it was a tone deaf move. One other thing, I think I had something on gold for you real quick. So, like I've been talking about a little bit, gold and Bitcoin have been acting like bellwethers, saying we think the Fed's rate hike cycle is ending. And I think we did see the last rate hike this past week. But let me pull up gold for you real quick. And I think I have that on my PowerPoint. Yeah, I'm going to just transition you over to that. And what I want to show you is that whole concept of what I've just talked about, that gold and to an extent Bitcoin, which has kind of been trading like gold with a 7 or 8 day lag, are representing the same kind of thing. And that is thinking that the Fed is done with rate hikes. So we did have this ascending triangle here, very bullish, right? And we got a breakout here. The breakout acted horribly. And this blue line that you're seeing is the 5-year treasury. So remember that treasury yields move inversely to treasury prices. So that's the 5-year treasury futures in blue. And at that breakout right here, you don't see a higher high in the treasury futures. So you did not have the bond market, which is the pro, right, on assessing where rates are going. You did not have the bond market confirming. You saw this little move again to another higher high in gold. Again, bond market not confirming, gold's coming down, sticking on this 2000 level. But now it is looking a little bit better. We still, I still would say, gold has a really big resistance level ahead of it. I'm going to pull that up for you. I think, yeah, we'll do it on Thinkorswim. So let me pull up gold futures and go with a daily chart if you're following along at home. If you're not, that's fine. Let me get rid of this crazy. Okay, so here we go. Gold futures. Oh, not stock finder. TOS. Okay. So gold futures, this is a daily chart. Gold's been acting well, right? This 2100 level is huge, huge. You can see we have major resistance right under 2100. So this is August of 2020, right? And this is March of 2022. What happened in March of 2022? The Fed started hiking rates. What happened to gold? It went down. Now that we see in October, my whole call for the phase one rally in October in the stock market was peak inflation, peak Fed hawkishness. That doesn't mean that the Fed was going to flip to rate cuts or pause, but peaked out at those 75 basis point hikes. Then they did the step down to 50 to 25. That's my whole theory, or what I was looking for, and what has come to pass in this October rally in stocks, in gold, is that it is reflecting that phase one kind of joy of peak Fed hawkishness. Now, the reason I think that when we move into phase two, we're going to be looking more at recession. And I think this is going to be kind of like a sell, like buy the rumor, sell the news. So basically the Fed, I think, is done. So this whole rally was kind of buy the rumor, whether it be gold or equities. And now that it looks like they're pretty much done, I'm sure they're done. I'm pretty sure they're done. We'll talk a little bit about that. We had earlier this week or towards the end of the week, I think it was Thursday, maybe, we had a full rate cut in July priced in, and then it got taken out on Friday. A full rate cut in July. So the Fed is saying, they're going to leave rates where they are through the rest of the year. The market doesn't agree with that. And right now we have 75 basis points of rate cuts priced in before the end of the year. So that is what the market is saying, and it's not what the Fed's saying. But in any case, with gold, yeah, we have major resistance here. This 2100 level is going to be a psychological level. So I think gold needs to break out above that. So what I would be watching is yields need to come down more for gold to do that, I think. And for certain people who are interested in silver, I think it's going to be the same case. And the dollar index. So gold, silver, stocks, they've all had a really high inverse correlation with treasury yields and the dollar index. Let me go to a 60-minute chart. And the reason why is because they both have been representing expectations for rate for Fed policy. So when we see the dollar top out over here, what is the date? September 22nd, right? When did the whole rally start? October. So we see the dollar coming down. That's very helpful for stocks. So the level I've been watching, and I'm surprised we didn't see some movement on it with the Fed this week, is right over here for the US dollar index. It's right under 101. It's around like 101, 100.70, 100.75. So if we see a breakdown below that, then that's going to be helpful for stocks. It's going to be helpful for gold. It might be helpful for Bitcoin. But if we see this as kind of a double bottom and the dollar rallies, why could it rally? Safe haven flows, potentially, it could. But I think this is a very important level for gold, for the equity market. So if we see that breakdown, we have a little bit more time in this rally. But if we don't get that and we see the dollar actually moving higher, that could be problematic for a few asset classes, depending on why it's moving higher. But dollar. We covered gold, we covered dollar, we covered stocks, we covered oil. So basically the takeaway, and the reason I want to connect with everybody today is, one, last weekend's live stream was the first time I said, look, I'm seeing changes in character. I'm seeing kind of shifts that are not what I would call the end of the rally, but they are changes in tone. And what I have always noticed, and the hardest things to pick up if you're not watching the market all day, is changes in character precede changes in trend. The market will warn you, but they're subtle. They're subtle warnings. Sometimes not so subtle. Crude crashing 20%, not so subtle. But so I do think we're late in phase one, which is that whole rally stage off the October low based on the Fed peak hawkishness. Stage two, phase two, is that the market starts to worry about recession. The Fed is engineering a recession. You don't hike the Fed funds rate 500 basis points in a year and not expect a recession. The reason they want a recession is it kills demand, it kills inflation, right? The reason everybody's going to be watching this sluice that's coming out on Monday is they want to see if if the banks are tightening up, if lending is becoming more difficult, if getting credit is becoming more difficult, because the Fed is hoping that the banks will tighten policy for them and they don't have to hike anymore. And that'll bring inflation down. So the potential of a converging crisis is that inflation, although it has, in my opinion, peaked, is still too high, right? Then you move into a recession at the same time, which is kind of like the stagflation theme. Those are two things that, we've seen that before. But you look at what's going on with the banks, and it's weird. With every Fed rate hike cycle, something breaks inevitably. They act too late. They do too little at first. And the example of that is that we knew at the website a year before the Fed admitted it that inflation wasn't transitory. You could see it in the copper gold ratio spiking, right? So over the next year, they're still pumping $120 billion a month into treasuries and mortgage-backed securities, which goes into the market. So as the market rallied, this is a true story, as the market rallied, I think it was in 2021, August, it was like 100%. It had gained 100% off the COVID crash lows. And if you looked at the Fed balance sheet the same week, it had moved exactly 100%. I think it was from 4.1 trillion to 8.2 trillion. So the Fed injecting money is bullish, of course, for the market. And that's why Bitcoin would do better if the Fed is, basically injecting money in the market, because Bitcoin tends to be on the speculative side of asset classes. But when there's a lot of money sloshing around, people will say, yeah, let's buy Bitcoin. When there's not a lot of money sloshing around, then they're going to go with more conservative stuff. So I think that we have the potential for three things that I haven't really seen in my lifetime: recession, still high inflation, and financial crisis, all converging at the same time. Haven't seen that. So I do think there is a really, really dangerous time in the market coming up, probably towards the second half of this year, starting in the second half of this year. I think we will move to phase two. Maybe phase one lasts the rest of the quarter, maybe, but I kind of doubt that. If we do get the mega caps breaking the S&P out above 4,200, it just depends on how quickly we see distribution. We see 3C, basically it contradicts price, so it's showing us distribution. But and then phase three is when nobody wants to buy stocks. It's a recession. It's ugly. Unemployment rate is really high, and the stock market will bottom before the economy gets out of recession, before unemployment starts to move. And that's phase three. That's the beginning of a new economic cycle, when you can buy everything on the cheap and just sit back and enjoy the bull market as the Fed does what they always do and pump billions and trillions of dollars into the economy. So I think that's it. Yeah, I think that's it. So the SLOOS Senior Loan Officer Opinion Survey, I think that's out Monday. Now, Powell mentioned that in the press conference on Wednesday. So the market's going to really be watching this. So that's kind of what we're going to be watching for early next week. But broadly, we're going to be watching for whether or not the mega caps can carry this market a little bit further. And then we're going to be watching if we get above S&P 4,200 for distribution. And if that's the case, then we're not going to be long anymore. Or we're going to be long things that are going to do well when the market goes down. Have a chance to sell into price strength above 4,200 and get short? I take it. I prefer being short, quite honestly. You make money faster. Stocks fall faster and harder than they rise. You have some of the best counter trend rallies. A counter trend rally in a bear market is way stronger than a rally in a bull market, believe it or not. Way stronger. So there's great opportunities. If that happens, I don't care which way we trade, long, short, it doesn't matter to me. What matters is being on the right side of the market. So I hope that we can do that, because that is my whole purpose. So if there's no other questions, let's wrap this thing up like a burrito. And I'll see members on Monday. Thanks everybody for joining.